What's up everybody, Gen X Dividend Investor here. In this video I show you how my dividend portfolio did this Monday when the S&P 500 fell 3%. And what I'm going to tell you next is going to sound like clickbait, but if you've been watching me for the last 5 years, you know I'm not a clickbaiter. Specifically, I'm going to be telling you about a trading strategy that has apparently been working for decades that has been making more money than investing in the S&P 500, which blew my mind once I understood it. But first I want to say that August 8th was my 5-year anniversary on YouTube from the time I posted my first video in 2019. It's amazing how time flies when you're doing something you love, and I want to thank each and every one of you for watching and thumbs upping and sharing and commenting on my videos, as it's because of you that I've been able to get to where I am. Okay, let's jump into things. This is a screenshot I took of my iOS Stocks app on Monday, August 5th after the markets closed. You can see that 3% S&P 500 drop, which was a decent amount for it to fall in one day, and so I felt it was an opportunity for me to reinforce the message that you have to have steady hands to weather rocky markets. And here's a screenshot of my portfolio in Fidelity's app, which shows a summary of how my portfolio did. You can see that I ended the day at a portfolio total of $3.086 million US spread across 3 accounts. My IRA ended at $1.36 million, and it was down 1.98% for the day. My taxable ended at $1.53 million, and it was down 2.68% for the day. And finally, my wife's small rollover retirement account that I manage ended at $194K and was down 1.96% for the day. Then here's a screenshot of my dividend spreadsheet tool, which dynamically updates throughout the trading day and shows all 3 of my accounts rolled into a single view, sorted by my largest positions up top. I'll zoom into my spreadsheet in a moment, but the key point in sharing this is to highlight how every single ticker I owned was red for the day, and in total I was down 2.33%. You can also see that my dividend income is a little over $128,000 a year. So me being down less than the market is what I'd expect would usually happen with my stocks, given that I have a fairly conservative, low beta dividend portfolio. My 2.33% drop means my portfolio fell about $73,000, which is a decent amount of money to me. I mean, my median salary over my 3-decade career was about $64,000 a year, so seeing a $75,000 drop in one trading day is not immaterial. But I've been investing long enough that it honestly doesn't bother me in the slightest to see drops like that anymore. A nice thing is that I literally have no stress when I see a drop like that, and the more I focus on quality dividend stocks, the less angst I have when markets crash. Sure, if one of my stocks fell 90% in a day, I'd feel annoyed, but I know that sometimes things like that happen, and that being a buy and hold investor should yield long-term gains, assuming you're in quality stuff. Okay, let's quickly go through my accounts in my Fidelity app, which I thought would be fun to use since I normally show you my portfolio using my desktop browser. So this is the balances page of my IRA, and it shows you the total account value in it at $1.36 million, and that it dropped about $26,000 that day, and it shows that I have $929 in cash. To understand why I have $929 in there, let's take a look at my IRA's activity page. This shows that I got a JEPQ dividend for $1,129 on August 5th, and then I turned around and reinvested $200 of it across a $1.99 buy and a $1 buy to get more JEPQ. Then I took out the remaining $929 of dividends out of my retirement account and transferred it into my checking account. I'm under the retirement age where you can withdraw penalty-free, so come tax time I'll owe an extra 10% penalty tax on my early withdrawals. I'll probably do a 72T at some point, but I've not committed to doing that yet. Anyway, when I do early withdrawals from my retirement accounts, I usually set aside some of that cash in a dividend taxes account so that come tax time I have what I need. And for reference, my taxable account is almost all qualified dividends, which have nice taxation implications, and I also have an MLP in there which is effectively tax-free to me for another 7 years or so. Specifically, I'm talking about my EPD position, which pays me $2,511 a quarter, all of which is at 0 taxes right now, and I'll be getting its distribution later this month. Today is August 7th when I'm doing this part of my video, and I got about $2,200 of BTI dividends across all 3 of my accounts. Later this month, I'll get $945 of Realty Income monthly dividends, $1,444 of AbbVie dividends, $775 of Procter & Gamble, $333 of Colgate-Palmolive, $291 of Caterpillar, $102 of Apple, and a little over $500 of Devo, for a total of $10,339 this month, which is a tad under my average monthly dividend payout of $10,682. I can't express how thankful I am to own decent dividend tickers that I trust will continue to pay me more and more. Anyway, my entire JEPQ and Devo positions were 100% bought from stock appreciation, so it's kinda cool to gas your portfolio a bit with the house's money, so to speak. They've both performed much better than I anticipated, so that's nice as well, though it's over a relatively short time frame, which is kinda useless to judge something by. Okay, let's look at my positions in my IRA. This is page 1 of 3 for my IRA tickers listed alphabetically, and I've covered my account numbers in each screenshot. You can see that I have 247 shares of AbbVie, then 179 shares of British American Tobacco, 207 shares of Caterpillar, then Colgate-Palmolive, Chevron, Devo, Duke, and Goldman Sachs. Later on, I'll show you my dividend spreadsheet, which has a roll-up view of how many shares of each stock I have in total across all my accounts, since I own multiple of the same ones in each account. Okay, and here is page 2 of my retirement tickers, and I've got Goldman Sachs, JEPQ, J&J, Kimberly-Clark, Coca-Cola, McDonald's, Altria, Realty Income, Pepsi, Procter & Gamble, and Starbucks. And finally, SCHD, Toronto-Dominion, and ExxonMobil. Moving on to my taxable account, and this shows it's at $1.53 million US, and it fell about 42 grand that day. It has no cash balance in it because I have it set up in Fidelity to automatically move all dividend cash it gets to go directly into my checking account. Here's my first page of taxable tickers, and we see 408 shares of Apple, 416 shares of AbbVie, 2,607 shares of BTI, then Colgate-Palmolive, Chevron, Duke Energy, EPD, which I just talked about, and J&J. Then Kimberly-Clark, Coca-Cola, McDonald's, Microsoft, Realty Income, Pepsi, Procter & Gamble, Philip Morris, and SCHD. Finally, I have Southern Company and ExxonMobil. Then we come to the Rollover account, which has $194K worth of divvy stocks in it. It has $203 of dividend cash that I've not withdrawn yet. In here we see AbbVie, BTI, Home Depot, J&J, Altria, Realty Income, Toronto-Dominion, and Travelers. Now let's switch to my dividend spreadsheet to see my positions ranked from largest to smallest. So this is my first of 2 pages of tickers, and you can see that Realty Income is currently my largest position, and in total across my 3 accounts I have 3,593.9 shares of it, and it's 6.89% of my portfolio, and you can see all the red in the price and daily change columns. I have over 212 grand of O, and it's next paying on August 15th, where I'll get $945 of dividends, and I make $11,342 of O dividends each year. My goal is to get that O position to the point where it's making $1K a month, so right now I take a couple $100 of its distribution and reinvest those into itself, and then I spend the rest. O has been doing nice lately as people feel interest rates are going to be dropping soon. I'd personally rather see O falling in price so that I can keep getting cheaper shares while I'm gathering, but I'm okay with whatever. After O, my next largest position is SCHD, then Altria, AbbVie, J&J, Microsoft, ExxonMobil, Pepsi, Devo, EPD, JEPQ, Procter & Gamble, Duke, and then Coca-Cola. And then here is page 2 of my tickers, and we see McDonald's, BTI, Southern Company, Apple, Goldman Sachs, Kimberly-Clark, Philip Morris, Chevron, Colgate-Palmolive, Caterpillar, Toronto-Dominion, Home Depot, Travelers, and Starbucks. In total, I have over 37,000 shares of stocks, and I make around 128 grand a year in divvies, and across my 28 tickers, my average weighted starting yield is 4.15%, and my average weighted 3-year dividend CAGR is around 5.57%. And here's a view of my portfolio that shows my current dividend income, how it's expected to grow over time, with the top row of numbers being the no drip row, which means how my portfolio could grow if I'm spending all the dividends, which I'm basically doing, or the drip row on the bottom, which is how fast it could grow if my historical dividend hike rates continued into the future, assuming I was reinvesting all my divvies. I'm reinvesting a small amount into a few tickers, so I'll probably end up between those 2 lines. So 10 years from now, this estimates that I could be making 220 grand a year in divvies if I spend all of them, or about 317 grand a year if I was reinvesting them all over that time. Either way, it's pretty sweet. So the 128K a year I'm making right now is about $10,680 a month, or $2,465 a week, or $351 a day, or $14.63 an hour, every hour, while I'm sleeping or playing video games or whatever. This also shows me that the SP 500 ended at 8.53% below its 52-week high, whereas my portfolio was down 2.32% from its all-time high. My lower beta stocks are giving me lower volatility, which translates into often having smaller swings. On the next day as I was working on this section of the video, I saw that the SP 500 rebounded up 1.04%, whereas my portfolio only went up 0.65%. So things are going as I'd expect, and are what I like as someone in retirement, though I'd seek more beta and growth possibilities if I was younger. Now, some people might freak out to see a portfolio drop 74 grand in a day, but I'd encourage those people to not focus on one day and instead to understand that I'm at a stage where my needs and goals and risk tolerances are probably different than yours, and I'd expect that over the long run my portfolio will trend up nicely, and my dividend income will trend up as well, with some hiccups along the way. Sure, sometimes one of my tickers might cut their divvy, and in that case I'll probably sell and move into something else. Okay, and here's a view of my dividend income since I started this latest incarnation of my spreadsheet, and it shows a nice trend up over time. One question some people might ask is why did the markets fall so much on that day? There are a ton of possible contributing factors, but it's not always easy to know why the market does what it does. Maybe the unemployment numbers spook people, or perhaps tech earnings weren't as robust as people wanted. Maybe folks started feeling that we're in for a hard landing. Maybe Buffett unloading a large position of his Apple stock holding in Berkshire Hathaway freaked people out. And for the people who missed it, let's check out what one of my favorite stock research tools I like to use in Seeking Alpha, which I'm an affiliate of, said about Buffett's sale. Here we see a variety of articles and perspectives that Seeking Alpha's authors have about what's going on with Apple. Like one person has an article that says Apple is not a buy, it's a hold, and that it's too overvalued and its earnings are not outstanding. I kinda agree with that, though I'd say that its earnings are outstanding, but its earnings growth are not. Another article title is Apple Exit with Buffett, and they have a sell recommendation. Or this recent one is called Apple Hyper-Focusing on Berkshire's Stake is Overkill. Let's dive into that one for a sec. Just a quick scan has some interesting tidbits in it, like here it mentions that the Department of Justice recently won an antitrust lawsuit against Google, and Google paid Apple a royalty fee that amounted to $20 billion, and that even though this will be appealed, it'll still be a headwind to consider. I often learn new things reading Seeking Alpha's articles, so I appreciate the value I get from them. Like Berkshire Hathaway just cut their massive Apple stake by nearly 50% in Q2, and perhaps they did that because Apple is such an overly large position for them that they were concerned that Berkshire stock was basically just Apple, and that didn't make sense to them. Maybe they were concerned that Apple's growth story wasn't as compelling as it used to be. Perhaps it was because they wanted a bigger cash hoard to capitalize on potential opportunities. There's lots of possibilities, and these days I'd never buy or sell a ticker without first seeing what Seeking Alpha had on it, and I'd also check FASTgraphs, something I'm also an affiliate of, as it has a slew of other insights I really value. Both these tools are incredibly valuable, but neither are perfect, and I do feel they increase the odds of my success with long-term investing, and thus their subscription costs are well justified to me. Now take a listen to this 90-second CNBC clip to get their perspective on Buffett's Apple move.
Then there's the idea that, well, what does Buffett know that the rest of us don't? Because he takes off half of his Apple position in the second quarter. So that stock's down a bunch. And Jimmy, I'm going to get you in a minute, but I want to bring in Josh Brown for a moment to comment on, Josh, what you think about this move from Berkshire, how you're thinking about Apple, and you know so much about how, you think that Berkshire makes some of its investing decisions, or you've certainly made it part of your career to try and figure it out. Just what's your take?
So I was surprised because you tend not to see him do things like cut a position in half. He either gets all the way out or he gradually reduces. So he has done things like this before. But again, this is a little bit more on the rare side, especially when it's his largest position. Keep in mind, Apple was half of Berkshire Hathaway's stock portfolio and worth about a quarter of its market cap. So this isn't just like, oh, I bought a little bit of Goldman Sachs and then I sold it 2 quarters later. This is something a little bit bigger. But I think one of the things that you're hearing in the media that is not true is that the percentage of cash is some incredible amount relative to what it has been historically. On a dollar basis, it's higher than ever. But Berkshire's market cap on a dollar basis is also higher than ever. So this doesn't strike me as Warren trying to signal something to the market or anything like that.
So back to why the market dropped 3% that day. Are we perhaps on the cusp of a worldwide recession? Are politics and general strife driving the volatility we saw? Are computer algorithms firing off for whatever reasons, doing buys and sells and enabling lots of swings? Are interest rates not moving down as fast as some predicted, or perhaps is AI's potential not materializing fast enough? All of those are probably contributing factors, but one of the most fascinating reasons the market went wonky is due to a trading strategy that is blowing up in investors' faces called the yen carry trade, or the Great Unwind. You see, for years, Japan has been the go-to place for cheap borrowing due to its consistently low or near-zero interest rates. Investors could borrow Japanese yen at minimal cost and invest in high-return assets like U.S. tech stocks, government bonds, or foreign currencies such as the Mexican peso. As long as the yen remained low against the dollar, investors could repay their loans and still profit. The yen carry trade gained popularity in recent years because Japan was the only major economy offering essentially free money, while others raised interest rates to combat inflation. Borrowing for nearly nothing and earning a 5% return on U.S. Treasuries seemed like a no-brainer. But carry trades are not without risk. They rely on favorable exchange rates, and when the yen's value began to rise recently, it eroded potential profits. The Bank of Japan raised interest rates for the second time since March, increasing the yen's value and making yen-based loans more expensive to repay. Simultaneously, the dollar weakened due to signals from the Federal Reserve about potential rate cuts, and U.S. tech stocks declined. This combination led carry traders to exit their positions quickly, creating market turmoil. Carry trades are leveraged positions, meaning they involve borrowing, aka debt, which increases risk. Minor losses can trigger margin calls, where lenders demand more cash to cover potential losses, forcing investors to sell assets or close positions. This can create a downward spiral, with initial liquidations causing further losses and additional sell-in. On Monday, the Japanese stock market fell 12.4%, sparking a global sell-off. By Tuesday, Japan's stocks and U.S. markets partially recovered, but the situation remains precarious. So I personally wouldn't do something like that, as I'm an investor and not a trader, and I wouldn't borrow money to invest in stocks or currency, but it really blew my mind when I finally understood what was going on. The reality is that I have no idea where the market is going to go in the short or medium terms, but in the long run I believe that solid companies will sell products and services that people will pay for, and I intend to remain invested in decent assets that pay me a share of their profits in the form of a dividend. I don't need to day trade or try crazy tricks to get rich. I just plod along, slow and steady, investing in decent companies at decent prices, and over the long run I think I'll do fine. I'm okay with swings and crazy things rocking the markets, and I expect them to happen, and I plan to just keep holding companies and tickers that fit my risk tolerances and expectations. If I had to guess, I'd say that we'll see 1 or 2 rate cuts in 2024, and if that happens, then I'll probably get extra oomph in my dividend stocks. And right now, this fear and greed index is showing us at extreme fear. It measures 7 barometers of market sentiment, and history often shows us that stocks go up after Wall Street's fear index hits these levels. So leave me a comment telling me what you're doing these days. Are you holding and watching what's going on? Are you actively buying good deals? Are you selling and planning to re-enter in the future? How bad was your portfolio hit recently, and how much did you rebound by? I always love reading your comments. And with that, I'd ask that if you got any value from this video, then please hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Now I'd like to shout out Art, who just signed up as a Patreon aristocrat. I'd also like to shout out Med School AV, who just upgraded from a champion to an aristocrat. Next, I'd like to suggest that everyone consider using my FASTgraphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment, even if they sign up for a full year. I'll also recommend checking out my Seeking Alpha affiliate link, as new users can often get good discounts for signing up. Plus, take a look at my Patreon seats if there are any you want to sign up for, but since my Patreon Aristocrat and King seats are usually sold out, I'll also recommend that you join my channel membership, which gives you a variety of perks you can check out. And don't forget to join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 82 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.